Hey everybody, welcome. It's Thursday afternoon here in Orlando, Florida, and Thursday evening if you are in the United Kingdom, where most of you are, a few of you in Europe, but welcome, thanks for joining. It is Thursday, July 17th. I had to check the date there for a second, was confused. I'm having a really bad hair day. Sometimes it happens. Have you ever had a bad hair day? Oh, it just sucks, but good day to have a bad hair day when you're supposed to come on the camera and talk to people. Did you see the beautiful view outside? The blue skies peeking through. You can see a gentleman mowing his grass. See, this is live with a very broken fence. Yeah, it's very hot here. I don't know how hot it is, like 30 degrees. Typical British non-weather. Actually, you guys have been having hot weather, haven't you? But yeah, it's pretty normal for here. Just hot, steamy, humid. Nice at night. That's what I like about it. You can go out at nighttime and not be cold. So, what are we going to chat about today? We got a little bit of peer-to-peer lending news, of course, as we always have. We're going to take a look at Cufflink, a deal that was put on the platform with a little rate bonus. Talk about that deal. What's going on with that? We're going to talk about easy money. A couple of letters from the mailbag, as we usually get. And what else? Oh dear. Not that. Somebody who said they're having a hard time getting started with their investments. So we're going to talk about that. And we'll talk about a investment in myself that I've made. Not really. It's not an investment. It was a purchase, a personal purchase that I've been fighting with for months and months and months, whether I was going to make this purchase. And it actually came from a email that I'd gotten several months ago about somebody who was struggling with making a purchase and the reasons why they didn't want to do it. And we had a bit of a discussion about that. It was kind of pertinent, so I thought I would share that with you because maybe you guys have some of the same feelings about treating yourself and spending money on yourself, because we live in this society of save. Got to have this pension pot. Don't spend anything, blah, blah, blah. So I'm going to talk about that. I'll tell you what I did for the good or the bad. Yeah, that's it. So if you want to get a shout out, say hi in the stream. If you could hit that thumbs up, that would really help out. For reasons that are beyond my understanding, the algorithmic reasons that everybody who goes on YouTube talks about. Subscribe to the channel if you haven't already, and consider subscribing to Patreon. Thank you to everybody who is a generous Patreon supporter. It does help keep the lights on, the streaming software running, blah, blah, blah. Anyway, good evening to Invest24. Let's get P2Ping. We certainly will. Paul Bagworth, Israel and Kenilworth, Peter Vince and Leatherhead, Stephen Hale in Nottingham, and Colin Perry in the Peak District. You know, it's been years since I started doing these live streams. I think it was, I don't know, what are we, 2005 was it? 2000? Maybe it was 2019. I don't remember, but some of you have been here since the very beginning, and I really appreciate that. Even for those that haven't been with us from the beginning, thank you so much for tuning in. You are the reasons why I keep doing this, as I remain unsponsored and have zero financial support for continuing to do this. But I do it for you guys because you show up every week, and I feel you want the information and you want the entertainment. Maybe it's more information than entertainment. We'll see, but thank you so much for being here, spending an hour with me on a Thursday, sometimes on a Saturday, but for reason, it's reasonably been on a Thursday recently, so just like old times. Anyway, we're going to get into a little bit of news and then talk about some things. Let's see. Let's go. Come on. Easy money. Money has never come easily for most people. Easy money, innovative finance, ISA. The ISA that you can get with a £20,000 tax-free investment. Every year, they have hit £100 million in their innovative finance ISA. UK peer-to-peer property investing platform Easy Money, IFISA, has surpassed 100 million in investor funds. That was launched in 2018, so it's taken them 7 years to get to 100 million. It has seen investor interest grow significantly over the past 7 years, with its £100 million milestone now making Easy Money one of the largest IFISA managers in the United Kingdom. Easy Money, as you all know, specializes in offered property-backed UK loans, and all of these loans can be held within its IFISA. The platform is currently targeting returns of between 5.4% and 10% per year, depending on the type of account chosen. I did actually get a question about Easy Money too in the mailbag, so we're going to go back to that in a few minutes. Let's keep going. Well done too for Easy Money getting to 100 mil in an IFISA. That means that many people have entrusted Easy Money to hold their pension cash, so it's no small amount of money. The UK government is to allow retail investors to invest in LTAFs through ISAs. The UK government is set to allow people to invest in long-term asset funds through their stocks and share ISAs, enabling to invest in private markets through these tax-saving vehicles for the first time. And I admit, I didn't really know what LTAFs were, so I had to do a little chat GPT. Tell me. I put in a cool prompt. You are a world-class UK-based financial advisor. Use your knowledge to advise whether UK long-term asset funds, LTAFs, are worth investing through a tax-free ISA. LTAFs are a relatively new UK fund structure designed to give retail and institutional investors access to less liquid long-term assets such as private equity, infrastructure, real estate, and private debt within a regulated, diverse fund framework. I would imagine most people don't even understand this like I didn't. Here's the breakdown of the considerations. You get tax-free growth on long-term assets through an ISA, access to a liquid private market. So illiquid means not liquid, means you can't get your money out very quickly. Compounds over time, blah, blah, blah. Key risks, look at these. They've got some definite key risks if you're considering LTAFs. They're not daily dealing funds. This is highly important. Redemption may be monthly, quarterly, even longer. So it means they're not liquid. If you need your money back quickly, you probably are not going to get it if you want to exit. Valuation uncertainty. Illiquid assets can be hard to value in real time. Pricing may not reflect true market conditions in volatile periods. NAVs, that means the share prices, may lag or be revised, which introduces opacity in what your investment is really worth. Regulatory landscape still developing. ISA allocation limited, so you can only put in 20K. Look at this. Investor profile, high risk tolerance, long-term horizon, 5 to 10 years, stable income, low need for liquidity. It's interesting. So when I see things like this, these news articles come out with the UK government is set to allow retail investors to invest in long-term asset funds. And then when ChatGPT is telling me something that I already knew, which is this is a high-risk investment, it really pisses me off. And let me tell you why. The government decides what you guys get to invest through, which I don't have a problem people investing in, high-risk investments. What I do have a problem is the government saying what you can invest in. You cannot put cryptocurrency, Bitcoin in IFISA, but you can put this high-risk product in there, which is obviously a very high-risk product. I mean, it doesn't take much common sense to figure that out. ChatGPT will tell you the same thing. That's where I really have a problem, and that's why I don't like the government's hands in deciding what you and I are okay to invest in. It should be an all or nothing. I believe if it's high risk, it's high risk. Everything is should be grouped in a high risk bucket and let people invest in what the heck they want to. It's your money. Like, why would the government be okay telling you what you can and cannot do with your own money? I'll tell you what it is. It's the financial industry having so much power and so much money backing government decisions, even though they would tell you otherwise. They get to decide what goes into regulation and what doesn't. This is a perfect case in point of it happening, and yet people remain non-confrontational about this, and I don't really understand why. This is a product that's getting approved, by the way, by the FCA. Here's a good quote down here. We're extremely pleased that LTAS will now be incorporated into the stocks and shares ISAs, a reform we have long called for to broaden access to private markets. Chris Cummings, Chief Executive of the Investment Association. Yes. Michael Aldridge, President of SLX, agreed the government's move will allow retailers to tap into lucrative private markets through their ISAs, but warned that this is a double-edged sword. Private markets are notorious for their lack of transparency. So investors need to make smart decisions in the space. Yeah. Investors are not going to be able to make smart decisions for the most part, as I would not be able to because I don't understand this, and most people won't understand it either. But there you go. This is what happens when governments decide what you can and cannot invest through, which, again, pisses me off. We got a email from Cufflink. So we're writing to inform you of a excited limited opportunity available on the Cufflink platform. This is Broadlands Avenue. They are going to give you a higher return bonus on this project. You can earn up to 8.73% gross per annum compounded monthly. If you've already invested reserve funds, your investment will automatically be increased to the higher rates. These higher rates are only available while the deal remains in reserve. Once the deal goes live, the rates will be reduced. I decided to go ahead and take a little look at what is going on. So you can see some projects here that Cufflink has. They have quite a few available deals, right? Let's see. Broadlands Avenue has quite a lot of tier loans. We have tier 1, tier 2, tier 3, tier 4. And you can see the interest rates differ, what's advertised here, but obviously they're having a little trouble filling, especially tier 2, 200,000 deal amount, and then only about 12,000 has been filled on that. So they got 225, 200, 275, approaching just south of £1 million. Obviously they're offering an interest rate boost to try to fill this. I don't know, I haven't really done a deep dive into this project because I don't tend to do select investments anymore. Auto invest for me is just so much easier. But if you are looking to get a rate boost, you want to get up to 8.73%. It's a pretty good project to at least take a look at. Do your own due diligence. I'm not saying this is a good project or a bad project. I don't know. But interesting email. Crowd Property has also some available live projects. Again, I don't know how much of these are available and what's good or not. I'm purely on auto invest now at this point, and I'm actually running my investment down through Crowd Property due to the amount of defaulted loans that have run past due. But they're offering some juicy rates if they don't go into default, 9.5%. Again, do your own research. Let's go to the mailbag. Hi, Lawrence. I notice you do not invest through Easy Money. Any reason why not? Do you have any thoughts on this platform? Thinking about putting some money in. Thanks, John. Well, the reason why I do not is, again, I'm trying to reduce the number of platforms that I have to a more manageable amount, and I'm trying to really stick to that game plan. I did consider increasing by one platform, but if we look at the investment amounts, they're very, very similar to LoanPad. What I don't like is if you don't want to invest 20 grand, you're only going to get a max of 5.71% of your target rate. With LoanPad, you can get 6.1% with 60-day access. So I would be falling in the premium category if I were to invest in. No, I don't necessarily think that getting 0.4% less is really a great idea for me personally. But if you are one of these high net investors, or even a crazy professional investor where you're willing to put in $1 million, you can get up to 10%. So I think it's a good option, especially if you're in these higher investment amounts. I don't really have anything negative to say about them. It says here you can ask to withdraw anytime. That means that the property should have decent liquidity. Not tested. I don't know if that's true. But I did go into the peer-to-peer independent forum and noticed there was somebody here that was asking the same question. So I thought I would just pull it up. And these are the people that have experience in these platforms. This guy says, financier, I'm disillusioned with many other peer-to-peer and similar lending platforms where an eye-watering ratio of my loans are now in long-term default. Therefore, I'm thinking of investing further sums into Easy Money. So far, Easy Money has been one of the rare ones that does what it says on the tin and has performed very well. I'm interested. However, even well-performing peer-to-peer platforms have a habit of suddenly beginning to suffer one problem after another and eventually becoming a horror story. Therefore, I'm wondering what everyone's latest thoughts on Easy Money is. That was posted back in September 2024. Benaj says the only issue I have is the rate versus the risk. To get 7.51%, the minimum investment is 100. I think he meant to write 100K. I don't know if that's true. Yep, 100K. Let me pull that back up again. Where'd you go? Here we go. 100K. You got to put. I read somewhere someone depositing nearly $10,000 a month with a bunch of regular savings with FCS protection getting 5+%. So good point. If you're going that deep into it with 100K to get 6.52%, is it the best option? Not so sure. Been with them for a few years with no problems. There seems to be a bit of cash drag. Il Morrow, who is a long-standing member of this community, have had no issues. Been with them for a while. Two concerns: lack of auto diversification, so each deposit is likely to get lumped into one loan and remain there. Second is the prolonged duration of loans and lack of any updates. I've got 6-month loans that are now approaching 2 years late. No explanation, no history. Seems like a rolling extension, so not so much transparency. And then he writes here, for the level of return, LoanPad is much better. Purely a diversification play. Let's see what else. I know there was somebody that had written about cash drag being an issue. Let me see if I can find it. Come on. Always liked Easy Money. However, the cues for investment are becoming a joke. 7.5% returns of 100 grand quickly becoming 6% when you've got 20% of your cash pending investment. That's probably how they make their margin. Dave Foz says it's been weeks. He had 25,000 queued. Eventually, he pulled it out and withdrew. It's better off with LoanPad, in my humble opinion. So, and then you've got Ilmara saying, mine's getting reinvested every same day, both capital and interest. So, conflicting stories. This is why I think it's best if you are looking to invest a significant part of the money. You just start small. You can put in £100, £1,000, whatever. If you're trying to put in 100, try it with £1,000, and test it out, see how long the cash drag is. Because cash drag, if your investment takes a while to get invested, obviously that's going to bring your returns down. So you're not really getting what's advertised. But other than that, I don't know. I haven't really heard of anybody having terrible issues with easy money. Maybe you could put it in the chat if you're invested through easy money. What's your experience been like? Do you think John should do it or not? Let's look at the Trading 212 portfolio. It's time. It's time, ladies and gentlemen. How are we doing? I haven't looked today, I promise. Last time I checked, last Thursday, it was 29,000, I want to say 300, maybe, somewhere in that range. Here we go. Oh, look at that. 30,926 pounds. This is an all-time high. You are seeing today an all-time high on the Trading 212 portfolio that has had a 22,851 pound return. So we started a little bit less than 8,000. Well, originally it was 5,500. Then I added, I think, another $3,000. 448.9% return. So it's doing well. Let's see where we are with the different investments. Now we're down to 5 shares, 0 cash. Everything has been deployed. I did pull out some money last week. I sold down some Tesla shares, which has bounced back about 7% in the green. Of course, as soon as I sell it, goes back up, but whatever. I'm okay with it. MicroStrategy now just a hair under 30% in the green. Our slow horse in the race, of course, the Vanguard S&P 500, 6.75%, slow and steady. Look at this, NVIDIA now close to 72% in the green. Amazon 19.19% in the green. Tesla 7.89% in the red. This is not rocket science, people. Normally this conservative me would not have any of these shares. If this was any significant amount of money, it would all be in this S&P 500. And I would just close this down and not look at it for 10 years. But in an event to see if I can actually beat the S&P 500, which I appear to have been doing by pure blind luck, with very, very high cap shares, these blue chips here. So it's not rocket science. I'm certainly not skilled, but the whole goal is to create as much value out of this account to give more money to charity. And that seems to be what's happening. So markets are acting crazy. Things keep going up. I think we might have another 20% year in gains with the S&P if we look at what is happening here. It's crazy to me. It really is. This is the year-to-date chart. The red line, by the way, is the FTSE 100, which is beating the S&P 500. It usually doesn't happen, but right now it is. But yeah, we've had a good year to date. I mean, both of them is 7.9%, 7.29%. The S&P's up and the FTSE's 8.63%. So both having a good year. Look at the mirroring, though, for the most part. When the U.S. market dips, the FTSE dips. But I always tell people zoom out, just because we're having a good 6 months of the FTSE. If you zoom out, the FTSE has usually tended to be way behind the S&P 500 over long term. See almost 50% lower over the last 5 years. So don't just think because we're having a good year it may continue. I don't know whether it will or not, but this is why I've always liked the S&P 500. It is crazy to think we may have another year of 15 to 20% returns. This would be, I think, year number 3, which is kind of mind-blowing that the whole thing has not toppled. It did briefly topple, but everybody thought that this little topple that happened here back in April was the beginning of the end, and since then we're almost 20% up from that low point. So kind of crazy. Let's go ahead and keep moving through. This is a letter from the mailbag. I don't know if you can see this. Let me just adjust the Zoom. It might be a little hard to read. Hang on. Come on. No, it's not. Is it locked? Is that what's going on? It's locked. Scene locked. All right, let me unlock it so I can... Boop. No, right there. Let's lock that again. Hello, mate. Hope all is well. Quick question. How the hell can I be inflation? I don't think you can be inflation, Barry in Wigan, but I think you meant beat inflation. Barry says, I have a bit of money in savings in the bank and a bit in loan pad, but it seems like everything is getting more and more expensive. Interest rates are pretty crap at my bank, too. I'll be honest, I have zero invested in shares, but don't beat me up too badly. I know I need to get started somewhere. How can I get started? Cheers, Barry and Wigan. P.S. How is Harley? I miss seeing her on camera. Harley's doing really well. She's sat on the floor having a sleep. She normally does. But, I mean, it's such an easy question to answer. You beat inflation by putting your money to work simply. Whether you go peer-to-peer, even if you go loan pad, you're gonna beat inflation, right? 6.1% inflation running. By the way, I don't know if you saw the inflation rates, but look at this. This is exactly what I said a year ago that was going to happen. Fuel and food prices in the UK drive unexpected jump in inflation to 3.6%. So inflation ticking back up. Again, look at this. Change CPIH annual rate is 4.1%, so it's going up. And the consumer price index, so goods and services, up by 0.2%. So going in the completely wrong direction, which who'd have thought that interest rate cuts would cause inflation to go up? Duh. Who'd have thought that? Right? Yeah. So inflation continues to be a problem, even though it's just a small uptick. But I think you're going to see inflation start to go back up again. I don't know if it's going to get up to this crazy 10% place where it was, but everything is getting more expensive. Barry in Wigan is right. You have to invest your money to beat inflation. You can't leave your money in the bank. If you're getting 5%, you're barely beating inflation. You're beating it by 0.9. And then after tax, if it's in a savings account, you're not beating it at all. But put your money to work in places that make sense for you. The easiest, obvious, always go-to answer is a trusty U.S. Vanguard Index Equity Tracker. And I want to show you, I've been talking about this fund for years. And right now we're sitting at 1,042 pounds a share today. That's 3,521 stocks and shares in this portfolio. But you could have had a great opportunity if we go back. Let's go back a year. I'm going to show you 2024. And I was telling family members back then, put your money in here. And they said, no, it's too expensive. It's too expensive. A year ago, you could have put your money in at 913 pounds, right? Look at the price fluctuation. It's gone up and gone down a little bit here and there. You could have gotten in at 898 here in August of 2024. You could do what I do, is just put a bit in whenever you have money. And there you go. And this is what this equity index tracker has done historically. Look, it went all the way up to 1,108 pounds back in January. I think that was the all-time high. Dipped down a little bit. You had opportunities here when we had the dip to get into 882. Set and forget. Easy. But now sitting at 1,042. And there's a 300 difference pounds between the 52-week high and low. So if you want to get started and you don't want to invest in peer-to-peer lending loans, and you want to do something that's better than saving rates, you just go in here. It's simple. One easy investment place. Look at the beauty of this. The charge, 0.1% a year. Right? Plus there's a small platform. It works out to be 0.2 0.25% for the year, but it's 0.25%. It's good. It's easy. You can do income, and by the way, Vanguard does not pay me to tell you this, but it's not financialized. I just tell you what I do. You can do this in an ISA too and get all of those beautiful returns tax-free. They have an income and accumulation fund. I always say go accumulation just because the distributions on the income side are so small. You're getting a 1.01% dividend. It just doesn't make any sense. Look, the dividend on the income fund is only 0.01% more in the income fund, and yet the fund is worth less. £846. This is why you go accumulation. Don't take any dividends. The dividends go back into the fund, and therefore the fund price benefits from that big time, almost 20% higher. So the income does not make any sense. Just ignore that. But this is how you get started. Very easy. I would never beat up on you for not getting started. But if you don't get started and you wait another year, this fund could be at $1,300 or $1,200 or $1,150. You'll be getting in now at a better price. You'll never be able to time this price. We're at an all-time high at the moment. There'll always be an all-time high. You just keep investing throughout your investment lifetime. You'll be okay. Hope that helps. I know it can be a really scary thing to do, to invest money. I've had fears myself. But once you hop in, dip your toe in the water, you'll find the water is not too bad to go into. Another letter from the mailbag. This was an interesting one. Hi, Lawrence. I've been watching YouTube videos for the past year. I'm trying to sort out my personal finances. I'm 28 years old, so probably in a different age demographic to some of your viewers. To be honest, I'm having a terribly difficult time financially, finding it hard to stay positive. I went to university and acquired quite a bit of student debt, getting an IT degree that didn't land me the type of job I thought I'd be able to get. The IT job market is extremely saturated. A lot of it is being outsourced overseas. I had to move back into my parents' just to survive. Rent was too expensive in London. I really want to get onto the property ladder, but that seems next to impossible now. It feels like young people are going to have the hardest time setting themselves up unless they choose a very high-paying career field to enter. I was able to open an ISA last year and start putting small amounts in when I could, which is good, but retirement seems like a non-possibility. Do you have any words of wisdom you could share? Because I'd really like to think my situation can improve, but it's really depressing. Anyway, even if you don't reply, thank you for all that you do, Oliver. Oliver, very, very honest email. Thank you for sending that through. We really don't tend to address young people as much. Me being in my 50s, shouldn't say that, I'm actually 21, but me being 52 years old, somebody who's 28 just seems so generationally different to me. And the sad fact is that a lot of young people are really, really struggling. And my niece, who is a solicitor in London, newly out of law school, is telling me how difficult it is to survive, especially with the rents as much as they are, after you factor in taxes. And then Oliver really highlights an important thing to think about when you're looking to get a college degree when you're young, or a university degree. Be careful what you go into, because some markets can be overly saturated, and it can be difficult to find a job. The House of Commons Library has some very interesting statistics on student debt. Look at this. This is the student debt curve from 1990, when this just wasn't a thing back in the 1990s, where people took out debt to go to university. But look at this massive curve. We're now over 270 billion pounds of student debt that exists out there. And it's becoming more and more difficult for people to pay these loans off because they're not able to get jobs. The problem is that student debt is thrown at everybody who wants to take it, right? You can get a student loan having no job, no income, which means that everybody can go to university, which means the job market becomes more and more saturated as multiple people are going for the same degrees and going after the same jobs. It's hugely problematic. Now, I would say if university made people pay cash to go, a lot of people just wouldn't bother. They'd go get a trade and they'd go do different things. Everybody nowadays wants to go get an IT degree because they think they're going to make a ton of money in IT because everything is computerized. The problem is there's so many people getting IT degrees. Not everybody can get a job, as Oliver said. Oliver said right here, I'm having trouble getting a job, the type of job I thought I would be able to. So, number one, if you haven't gone to university yet, think carefully about what you're going to university for. You could spend $53,000. By the way, this is the amount of student loan per student. It's £53,000 per student. You can spend that 53 grand on getting yourself started in a business or doing something else. You don't necessarily have to go to university. Obviously, if you want to become a doctor or a solicitor, an engineer, you need to go to university. But for people going and studying writing or maybe IT or philosophy, sociology, my other niece is having the same problem. She took a psychology degree and cannot get a job. And it was very, very plain to see that that was going to be an issue. Unless you want to become a psychologist, which she does not anymore, she's having a hard time now. She has student debt. So all of this money is being given out, handed out freely by the loan companies that love to prey on students because students can go get as much financing as they need without any backing. It's very easy to get a student loan. And it's become a huge problem. So you see young people like Oliver. I say young because he's a lot younger than me. He wants to get on the property ladder and he can't. Well, the obvious, one of the easiest ways to do that is go live in places that have a low cost of living. If you're trying to get into a London property, you can see here the majority of properties sold in the London area last year were flats, selling for an average price of $541,997. If you want to buy a terraced house in London, this is going to cost you an average of $765 grand. Semi-detached, $774,000. Look at these prices here. This is a rather average-looking terraced house, 4-bed in London, going for 900 grand. Right, 900 grand. It's almost doubled in 18 years. Another property, 955. So, in answer to that question, you go places where it's cheaper to live. If you have to commute further out, you commute. Some places up north, you can buy properties in the low 200s, which is, I think, achievable. But I think it's easy to get depressed. It's easy when you're young to think this is never going to get any better, but you have to work on yourself. Try to increase your income, reduce expenses, live below your means, and start early. If you start when you're 28, I promise you, in 20 years, Oliver, when you're 48, things will be markedly different. I started when I was 41 investing. I'm now 52, so it was only 11 years ago. And I look back now and I think, God, I just don't really understand how I was able to accumulate money in my investment accounts because I used to squirrel away a little bit here and there. It's like 50 pounds here, 100 pounds here. And it just compounded and added up and up and up and up, and I just kept going. But yeah, if you do look in the short term, it can be depressing. You do have some hills to climb there, but focus on maybe getting some more IT education, learn how to do things that other people don't want to do. And you can't change the market. The market is what it is. It may be saturated, but there are plenty of people that are out there getting good IT jobs. But I think it's just important to stay consistent and stay positive. Just, give up what you don't need to spend money on, like stop going to the pub. I know people that spend so much money on alcohol every week, and then they complain that they're broke or they don't have any savings, no pension, blah, blah, blah. Quit the beer. You can put £50, a month. I mean, I know people are spending £200, £300, £400 a month on alcohol. Put that in your investment account. You'll be okay. So thanks for the question. And by the way, for everybody saying things are getting more expensive, look at this. This is the price of petrol in the UK. Back in 2012, it was 134p for a litre of petrol. And today, 12 years later, it's 134p. So everybody complaining about petrol prices, it's gone back to its 2012 price. Even if you go back to 2008, it was 118. Something like 119. So not that much difference. Not everything has gotten crazily more expensive. We did have this big spike where it went up to 191 during 2022, but things will really drop back down now, thanks to our friends in the Middle East. But inflation is a problem, and the debt is a problem. I wanted to see how much the UK debt is. And the weird thing is I get different numbers from different websites. This one says the UK national debt grows at a rate of £5,170 per second, 3.1 trillion now in debt, almost at 3.2 trillion. Yet this website, this debt clock, says 2.6 million. This one says 2.708 million. So, we do know that the UK has massive debt, and it is going up. It's about just under £40,000 per person, 72,400 per taxpayer, and this is not going down ever. The government cannot fix this problem. Unless the only way is they print their way out of problems, but that's not going to happen. What else? I was going to tell you. So, I got an email about, it was probably 8 or 9 months ago, about spending, right? This is a little personal story. And it really made me think. It was a guy who was wrestling over buying something for himself. I honestly can't remember what it was. It was, I think, about £5,000 or £6,000. I think it might have been like a motorcycle or something like that. And he was wrestling with this idea. He was in his 50s about buying this motorcycle, and how guilty he felt for spending money on himself, right? In his 50s. And it really got me thinking about how we've become so ingrained to save, right? Save. And I was considering, my car was coming up to 8 years old, and I'd been thinking about, I wouldn't mind getting a new to me car, not necessarily a new car, but a new to me car. And as you know, prices of cars have really shot up since the pandemic, and I was really wrestling with that. And I thought back to the advice that I'd given this guy that I knew about buying that motorcycle, and said, look, you can't take it with you, right? You can't spend money from the grave, as they say. And then I started thinking about taking my own advice, and it felt terribly reckless. Like, buying a car felt reckless to me. I think I paid $15,000 for my last car back in 2017. It was about 6 or 8 months old. And I decided I wanted to buy myself a car, because I never really spent money on myself like that, but I felt terribly guilty. And then I remembered this saying about, you can't spend money in the grave. And a friend of mine said to me, he said, Lawrence, well, either you can go get that car, or when you die, whoever you leave that money to will go and enjoy that car, because they'll probably buy a car with your money that you spent so many decades saving. And when he said that to me, I thought, God, he's so right. I personally, everybody's situation is different. Some of you have kids, maybe people that you want to leave your money to. I don't have any kids myself. I do have nieces who one day, hopefully, I can bless them with something. But so I decided, I'm going to go look for a car. And after 2 or 3 days of looking, I was getting really frustrated about buying this car because I couldn't find what I wanted, and I didn't want to buy new because because that didn't make any sense to me. So I said a little prayer to the universe, and this may sound very hocus pocus, but it's the weirdest thing. I said a little prayer to the universe. I said, universe, I'm looking for this car in this color with this spec. Please help me find it. And I was looking all over the USA for this car, right? I was looking on Auto Trader. I was looking in the wholesale auctions where car dealers buy their cars from. And literally the next day, the exact color, the exact specs popped up in a place 1,000 miles away up in New York. And I called the guy who was helping me source cars. And I said, I want to buy the car. I'm petrified to spend this much money. And I want to buy the car. I'm just going to do it. And I pulled the trigger on the car. And it took about a week to get it put onto a transporter. And I didn't even see the car. I'd never driven it. It was completely sight unseen. I went on the recommendation of the guy that was helping me buy it. And I bought the car. And it felt very reckless at the time. But I still think back to that saying that my friend said, either you get the car and enjoy it, or the person, when you're gone off this earth, they're going to love driving around in something that you paid for. So it was a kind of a wake-up call, and it's something that I wanted to remind you to, everybody watching out there, that you cannot really take it with you as long as you're responsible. You're not reckless. I didn't buy a Bentley or anything like that. I bought a car that was about $35,000 US, which seems to be the price of a decent car nowadays. I didn't want anything too old. It was low mileage. It had 6,200 miles on it, which for the US is practically brand new, because Americans drive huge long distances everywhere. So I bought the car, and it's important to remember that if you work all your life, it's okay to spend money on yourself, if you have the means to do it. If it's not going to put you in a financial bind, it's okay to spend money on yourself. Not everything has to be invested. Not every penny has to go into the bank or into an investment. I used to think that way. I used to be so tight when it came to money. I would not spend money on a nice pair of jeans or a nice pair of shoes or anything, because all I want to do was save for retirement. And who knows if I'll get to retirement? Who knows if anybody, any one of us gets to retirement? There's no guarantee. There's no guarantee. I have 2 people in my life I know have got cancer, late-stage cancer. One of them is just a couple of years younger than me, so there is no guarantee that we make it to that point in life. So just a message out there. Go treat yourself to something if you want, and if you're able to. It's okay. I hope that helps you if you're struggling with a decision. Now I find myself a lot more financially free. If I want to go spend £100 on a pair of jeans that I know is going to last me way longer than a cheap pair of jeans, I'll go spend the £100. I don't even think twice about it anymore. I really don't. Now, if I had only £150 in the bank, I wouldn't do that, but I don't think twice about decisions like that anymore. I'm 52 years old. I don't know how much more time I have left. I may have another 50 years left. I don't know. But I definitely think it's important to be free of that kind of wrestling that you might have with yourself about even just treating yourself to something that's £100. Just do it and don't worry about it. That's my advice. That's Uncle Lawrence's advice for the day. I'm not going to tell you what type of car I bought because it's not really important. I might take some flack for it. You could probably guess what it is, but yeah. So, and I have the other car sat in the garage trying to figure out what the hell to do with that. Because that's selling a car privately, by the way, is not so easy. FYI. Anyway, I hope you enjoyed the stream. It's getting up to 50 minutes. I'll see if you have any interesting comments, and then we are going to get out of here. Holly needs to... Yes, I see you down there. She needs to get walked. And before it starts raining out there, has the guy finished cutting his lawn? Yes, he has. Before it starts raining, we're going to go take her for a little walk. Hello, Annabelle Nyron. 37 degrees in Spain. Is it that hot in Spain? See how hot it is in England. Today in London, it is a balmy 24 degrees. It's not terrible. How hot is it in Marbella? I don't know where you are in Spain, but Marbella looks okay. 24 degrees. Oh, 33 tomorrow. That's warm. Cool. Invest 22. I've had very good returns from easy money with a rate of return of 6.57%. Withdrawing money when I need it, no problem. Cool. Paul Bagworth, I've been investing with easy money for a few years, no problem. Oh, by the way, hit that thumbs up if you can. I'd appreciate it. Stephen Hale says more bank rate reductions are on the way in August. I just find that so hard to believe. I just can't believe they're going to cut the interest rates now with those inflation still going upwards. It just wouldn't make any sense. I mean, it's just going to create more of a problem. But, the government can just print their way out of everything. Oh, by the way, speaking of printing money, we have to have a quick look at our friend Mr. Bitcoin. The ultimate defense against inflation and money printing. Mr. Bitcoin. How are we doing? 119,855 pounds today. Wow. Mr. Bitcoin, the Ponzi, right? The Ponzi scheme, the tulip, the implosion of the tulip scam. The tulip scam that has been going on now for, 15 years, 16 years? The tulips are just, they keep getting more expensive, these tulips. We hit a high of, hang on, I think we hit 122,944 US dollars on the Ponzi that everybody keeps saying is the Ponzi scheme. And one day people will wake up, I think, maybe. One day they'll wake up and understand. But until then, Bitcoin will still continue to rage forward, rage up. And it will not stop raging up until it hits probably $1 to $5 million. And then it'll be too late. That's okay, because those who know, know. Thank you, Annabelle. Yes, the guy who wrote The Psychology of Money has a new book out, How to Spend, which I intend to read. Cool. Yeah, I'd like to check that out. Alicante is hot. Author Morgan House. Thank you for writing about that. Yeah. Anyway, we're going to get out of here. I hope you have a wonderful weekend. It's almost the weekend. Thank God. I need it to be the weekend. It's been a long week. I'll see you next time. Don't forget to tell your friends and family about the YouTube channel and stream. I'm still working on that Investengine video that I should hopefully have done in the next 2 or 3 days. I'll show you how to use Investengine, which I think is a cool platform. And I'll see you next time. That is all I got for you. Have a great weekend. Take care. Thanks for joining. Bye-bye.